Hi everyone, my name is Paul Horn. I'm the Director of Financial Planning for Benefit Financial Services Group. This is our fourth video in a 5-part series where we talk about financial literacy. We're going to be focusing today on how to build and maintain good credit. If you have a good credit score, I promise you it is a cheat code in life, okay? If you have bad credit, it's a very expensive process. In fact, having a bad credit score can cost you hundreds of thousands of dollars in additional interest over your lifetime. As someone that had to learn this lesson the hard way, I hope you don't make the same mistakes. So let's start today by talking about what is a credit score. Okay, credit score is given to us by one of 3 different reporting agencies. That's Experian, Equifax, and TransUnion. Yes, that's right, you technically have 3 different credit scores. And your credit score can range from as low as 350 points to as high as 850 points. As individuals, we want to be aiming for 720 to 750 credit score to give us access to the lowest interest rates. When we look at someone's credit score, it's actually broken down into 5 separate components. The first component, which is 35% of your total score, is your credit payment history. Do you pay your bills on time? If the answer is yes, you're 1/3 of your way already to having a good credit score. The next biggest factor that they look at is going to be credit usage. Do you have credit and are you using it responsibly? What they're looking for is credit usage of no more than 20 to 30%. So let's say you have a credit card with a credit limit of $10,000. Well, then that means on the credit card, we want to carry a balance of no more than $2,000 to $3,000. The closer you get to your credit limit, the lower your credit score becomes. So just by managing your credit well and making your payments on time, that's 2/3 of your total credit score. The last 3 components are going to make up the last third of your credit score. The first thing that we look at here is length of credit history. So I probably don't know this, but the older you become, the easier it is to help raise your credit score because that length of credit history gets longer. So for most individuals, whatever is that first credit card that you have open, you typically want to keep that open to help that length of credit history. The other 2 parts that they're looking at is credit mix. So if you have credit, they want to see a different types of credit and that you're using it responsibly. So you're better off having 1 or 2 credit cards and an auto loan than say 3 or 5 different credit cards. And then the last thing they're looking at is new credit. So if you're running your credit too often, that's actually going to hurt and lower your score. So each time somebody pulls your credit or looks at your credit, it creates what's called a hard inquiry, and that can lower your credit score if you have too many of those. So if you're looking to get a credit card for the first time, for example, don't have it ran at 3 or 5 different banks, just choose 1 or 2 and go from there. Now, if you're trying to build credit for the first time, you can apply for a credit card on your own. If you're going to do that, I would strongly recommend starting with a place like your bank that you're already at and get their student credit card or their entry-level credit card there and then go from there. Otherwise, if you can't get a credit card on your own or if you want to find alternatives, there's 2 different routes that we can consider. The first one is using what's called a secured credit card. So let's say you can't get a credit card on your own. What you can do is take, say, $1,000, give it to the bank as collateral, and then what the bank will do is give you a credit card with a $1,000 limit. And if you don't make any payments or if you don't repay that credit card, they'll just take that money that you gave them as collateral and use that to pay off the credit card. So it's lower risk for the bank, so it's easier to get those to start out. The other option is you can actually piggyback off someone else's credit score. I see this most commonly with parents or with spouses. So let's say you have a parent that's willing to put you on their credit card. By using their credit card responsibly over time, that can actually help boost your own credit score. At the beginning of this video, I had said having a good credit score is a cheat code and it can save you hundreds of thousands of dollars in interest. So let me give you a real life example here. Let's say you're trying to get a mortgage for $500,000, trying to repay that over 30 years. If you have an okay credit score, let's say it's 650 points, that's going to equate to an interest rate of around 8.5%. With that loan, you're going to be paying $875,000 in interest over the 30-year period of that loan with a monthly payment of about $3,800. Now, if you can go from a 650 credit score instead to a 750 credit score, what happens is that interest rate goes from 8.5% to 7.5%. That's only a 1% difference, so it doesn't sound like a big deal, but I promise you, it really is. If you have a 750 credit score at that 7.5% interest rate, your payments are going to be $400 a month less than someone with a 650 credit score, you will pay over the life of the loan $125,000 less than someone that has the same loan at a credit score of 650. All right, so we've talked about ways to build your credit. Let's talk about ways to maintain good credit scores. Okay, it's one thing to build it, it's actually much harder to maintain a good credit score. Well, the first thing that we want to do is we want to review our credit scores from each of those agencies on a regular basis. The easiest way to do this is just reach out to whoever your credit card provider is. They probably give you credit reporting services for free of charge. If not, you can look at things like Credit Karma or other services out there that can also do this for you. But what you're looking for is to make sure the credit information looks accurate. If there's anything that's wrong on there, you can actually dispute that, have that removed, and that's going to instantaneously raise your credit score. So types of things that we're going to be looking for is, did a credit card company say that you missed a payment that you didn't miss? Or is there an old medical bill that was paid off that's showing as not being paid? If there's a mistake on your credit score, you can find things like that, get those removed to help raise your overall credit score. Along with just monitoring the credit, we just want basic good financial habits. We want to keep our balances low, we want to make our payments on time, and we don't want to overwhelm ourselves with too much credit usage. So if you apply what we've talked about in the first 3 videos, having a budget, using proper cash flow, not overspending, those same habits that are going to make you financially successful there are going to make you are going to help you be financially successful at raising your overall credit score. I understand this is a lot to take in this video. If you have any specific questions you'd like to address, feel free to reach out to us at financialplanning@bfsg.com. Thank you so much.